Hello and welcome to another lesson. We're going to start going deeper and deeper and deeper. And we're going to talk today just a little bit about market structure and essentially what is involved when it comes to market structure. A lot of people have overcomplicated market structure, but we need to utilize all of the structure in the markets to try and understand where the highest probable setups are likely to be. Now, we are likely to find high quality setups, but that does not mean that the setups we find are going to win every single time, but we utilize market structure in form of finding an edge in the markets. That is essentially what we're looking to try and achieve with this. So we understand in price that we're looking to move in a certain trend, whether we're going upwards or whether we are going down. It's very, very simple. We are aiming to buy at these low levels and we are looking to sell at these high levels. And now we've been able to identify trading ranges and we've been able to identify optimal trade entry levels and areas and Fibonacci and all that kind of stuff. We are able to find these positions a little bit easier. Now, when it comes to market structure, we need to think of this from the time frame perspective because price is fractal. And something we have to understand about fractal is it has a certain meaning to it. So if I was to type in fractal, it's essentially, and let me just bring that in right here. It's a geometric shape that repeats at a multiple levels of magnification. Fractals are often infinity complex and can be described as natural phenomena like coastlines, mountain ranges, that kind of thing. So we're looking to utilize price action in the exact same way because let's imagine just for a second this is a daily time frame and over here is a daily time frame as well. So in the daily time frame we are, for example, bullish on this side here, and then on this particular time frame here we are bearish. It is so important. I'm using time frames like this as an example. There are loads of different time frames, and I'm not going to talk about where to take these positions just yet. But we have to do our best to identify the trend on the higher time frames first. So what we have to try and identify is what price action is likely to do on a smaller time frame, because on a smaller time frame you're going to see price action trending in its upward trajectory just like this here. Now this could be a 1 hour time frame as an example, and on a 1 hour time frame you're going to see stuff like this go on. Now the way we look to engage with price is we wait for price action to break market structure and then give us a move to the downside. Because if price action was to offer us a sell position in a 1 hour area based on this market structure break that you see right here, you could get in the markets right here, just for example, and you could target 50% or of this trading range right here, for example. Or you could target inside this area some form of area of inefficient price action that you see inside the discount area of the daily range. That is essentially how you look to get into the markets. But this area here is not going to provide you with the highest probable situation. Because yes, this can absolutely play out, but what we're actually looking to do is to identify a break of market structure right here, or a change in state of delivery right here, which is actually in alignment with the daily time frame as well. Meaning you have a higher time frame level of liquidity, which you can look to target, and your lower time frame trade happens to be in alignment with the higher time frame trade, meaning you can look for setups targeting higher time frame price action. And actually, the good thing about this whole situation right now is when price action creates another range on a smaller time frame, you can identify that market structure range, you can measure that smaller time frame range, and you can look to get in on this particular range right here, targeting the higher time frame level of liquidity, because that area has not yet been taken. So this is your higher time frame liquidity. So until this area has been taken, you can assume you're bullish, meaning on a 1 hour time frame, you could be getting into the market at the next trading range, which is right here, for example. And you could be getting in once again up here because price action has not been taken. And then when price action has been taken at these levels right here, this liquidity on a higher time frame has been taken. You do not want to be looking, let's say it tapped it there. This particular trade in here now is no longer valid for me because I don't want to take it because this has already been taken. Now, what we have to try and identify is deleting all of this. We're not interested because we've taken this particular price action away. Now, what we're looking to identify from here is a new level of liquidity. We're looking to identify a new daily trading range right here. We're looking to identify another kill zone or inefficiency or anything like that in here. And we're hoping that price is going to basically come back down to this area. So on a 1 hour time frame again, we're not going to look to get into the markets here, but we're going to wait for price action to come in and then give us that next move, which you can see playing out right about here. And then you can look to get in on all of these potential retests targeting this area of liquidity here. So you could be in the marketplace, for example, here. You could be in the marketplace here. You could also be in the marketplace right here as well. When you are no longer in the marketplace is when this higher time frame level has been taken out. So therefore, if this carries on moving higher, you're going to go without it. You're not going to worry about it because price action at any random point can start reversing again. This is how I look for positions in the market. I am utilizing the higher time frames and then I'm utilizing the smaller time frames to help me give something called extra evidence before I take setups. So I could be bullish for a few weeks, absolutely fine. But when I come and take out this higher time frame level, that time frame is kind of invalidated. We no longer have a certainty of where price is definitely going to go, and we are ready for reversal. So yeah, you could look to just try your luck and then look to buy something in here or whatever. But at the same time now, don't be surprised when you suddenly get stopped out. And if you do, after taking this level of liquidity, you then can expect that price action's basically going to come back down and target this price action down here to help give you a little bit of a helping hand to help you push along to the upside. So that's going to help you get opportunities in the market, and it's going to help you, it's going to help prevent you from getting stopped out as well. So inside all of these areas, we're looking for the trading range. We're looking for the optimal trade entry level area. We're looking for the higher time frame stuff. We're looking for all of it. And the same can be said for the higher time frames on a bearish environment as well. Now I'm using daily as an example. This could be used as the weekly. This could be used as the monthly. This could be the 1 hour down to the 1 minute. Like I said, if we go back to the words fractal is a geometric shape that repeats at multiple levels of magnification. So once again, we can see here, what are we kind of expecting? We're expecting price action to come down just like this, and then we're expecting price action to do something like that. And then essentially we're expecting this sort of behavior to carry on happening as long as price action is giving ourselves valid moves. And once again, we can see here, if we just change the color of this, this can be, even if we change this to, let's just say the 4 hour, for example, and then we changed, and then we said that this one here was going to be the 15 minute, just as a random example on the orange one. See if I can just change the color of that. So now we know and identify what's what. And we're trying to just understand, right, in a bearish environment, I'm looking to sell at these levels right here. This would be a selling area. Maybe this would be a selling area until this level of liquidity got taken. This would not be. And then price action can push higher. I'm waiting for price action to come into a higher time frame area of inefficiency, just like this one here. And then this area right here would be an area I would sell from. This area up here would be an area I would sell from. And this area up here would be an area I would sell from. And I would no longer be interested in any opportunity once price action has swept that area of liquidity there. That's when it would no longer be validated for me. At this particular point, I am going to wait for price action. I'm going to measure my new trading range and I'm going to wait for price action to come into a higher time frame level of imbalance inside my premium area, where we're going to hopefully be able to identify price action coming back into this area and then giving us a move again. And inside this area, once again, I am looking to measure the optimal, the liquidity grab. I'm looking to measure my dealing range. I'm looking to find my kill zone for setups. I'm looking to try and identify some form of order block or area of inefficiency, anything like that, where I can hope that price would come into, and then I can obviously look to target the next level of lower time frame liquidity. But also, if this is the next level of liquidity all the way down here now, as a good example, price action is going to do certain things. Price action is going to create, once again, another area for us to come in because we've identified another range. So we're measuring every single range on a smaller time frame to see if price can come into it and then make a new low, which means lower time frame liquidity has been taken right here. And then we can measure the next range right here, looking for those areas, trying to identify all of this here. And then when price action takes this level here, we can measure this range if we want to, but just understands that I'm not looking to engage because we've already taken out a higher time frame level of liquidity. So what I would look to do in this example, I would probably wait for price action to come back to this level here for just an example. I would want to see price action push higher on an even smaller time frame. So now if this is a 15-minute right here, this here could be maybe a 2 minute, for example. And I just want to make extra sure. So on a 2 minute time frame, we're going to be able to see price action come back to this level here. And actually, I have a smaller time frame area of liquidity to target, meaning I can look to get involved in the market at this particular level here. This is market structure. This is essentially what we look for when it comes to trading price action. And we have to try and identify where we are with certain levels on price. If we go to this particular time frame on the NASDAQ just here, we can see price action is absolutely everywhere. We can see we've had consolidating price action. We can see in this situation here, we've been very, very bullish. And you can see price action came all the way into this area of inefficiency right here. If we measure this trading range, you should be able to see almost an exact reaction towards that level of imbalance there, literally almost at the 71% level, or as good as anyway. In fact, if we just bring that a little bit down, generally just a pip or so away from that 71% level. Now, if we try and identify what happened in here, for example, maybe on a 1 hour time frame, you'll see that price action looks a lot smaller. And now what we actually have in here is higher time frame levels to identify, because price action, as you can see, has swept this liquidity right here, created a really nice trading range, as you can see right here, huge order block, area of inefficient price action. There's your first trade opportunity right here, just targeting this intermittent term low high, sorry, which is right here for a 2-to-1. And then you'll be able to see that price action creates another range and another range, and even starts pushing to the upside in this format here. But if you held this position, just one position, and we wanted to target this particular high right here, well, that is a very decent high for us to look towards for a 5-to-1, because actually, if you look at price action, that is the range that has been created on the daily time frame. So we're looking to identify the higher time frame levels, and you can see from this overall range all the way to the smaller time frame, you should be able to try and identify positions in the market. You can see here we had an obvious liquidity grab, and this is price action that will confuse you at times. You can see here price action came in, swept lower, huge news release, pushed to the upside right here. Price action comes all the way back down into this sort of area right here. Price action pushes higher, then reacts. You can see here, price action creates this trading range. Price action comes all the way down, pushes in, and then comes back down to this level here. Very, very ugly price action. But this is about finding the best opportunities and holding on to them as well. Because you could trade in here, you could try and look for an opportunity in here. You could also just wait for price action to hit these levels. This is stuff that happens all the time. If you look at any type of price action on a random pair, if we go back to Euro now, for example, what we're currently doing as we speak, we've been very, very, very bearish the last couple of weeks. And we can see and identify in this area right here, price action came lower. As we can see, if I measure this entire lower range right here, you can see it didn't come to the optimal trade entry level, but it came to 50% and above, which is absolutely fine. There's no issues with that because there's also another area of inefficiency which sits within it. Perfectly fine. If I just to make this a little bit easier, I'm just looking to reverse this here. So now we have this opportunity which is kind of sitting in here. When price action does look to start pushing into here, it's now just about how many opportunities we can look to try and frame from these levels. You can see price action come in and aggressively break to the downside on the 1 hour time frame. If you measure this level, once again, you'll see price action doesn't come to the 71%. That's not a problem. Maybe you had an entry here, for example, that would have been a really good entry. And in fact, if you had have taken the entry in this level here, you can see that price action did come back before pushing lower. You would have just had to wait for it. But if you look at this here, this time, the time of this particular print right here is 9 o'clock in the morning UK time. That is the London session. So inside this higher time frame area of inefficiency, which played out right about here, you can see that price action came into this area here. Now, if you go to an even smaller time frame, and you could be able to identify price action coming into these levels. So you can see right here, this is the London high, price action comes down. You have got a smaller time frame right here, and then you have got another area here. Price action comes into the 71% level and then drops lower. You can then see it starting to respect lower time frame areas of imbalance all the way down to this level here. So you could be a seller at all of these areas of imbalance before it gets to this level here, just as an example. Now, the smaller time frames isn't something I'm talking about at this moment in time. And in fact, I'm not looking to try and promote the smaller time frames just yet. It is definitely a subject we will get into as we go deeper. But I'm just trying to show you the possibilities of what happens if you try and pay attention to all aspects of market structure. Trying to keep in line with the higher time frames is one of the most important things you will do as an aspiring trader. This is not to try and trip you up. This is not to try and trick you or anything like that. We just have to try and identify where we're thinking price can kind of go next. If you look at another random pair, you should be able to see price action from the highest of time frames from the 4 hour chart right here. You can see price action come all the way up here, came back down. So if you measure this range right here, for example, you can see price action in this instance actually came in to the kill zone, which is right here. That's your optimal trade entry area. So if you go to maybe if we were on the 4 hour, we can look at the 15-minute from here. Just as an example, you can see in these levels, price action is pushing higher as we speak. Now, look, this is an area of imbalance. As you can see right here, price action come into that area of inefficiency. Price action did not make it to this level right here. And that sometimes happens. Didn't even get to 50%, but that is not a trade worth taking. However, you can see we've got swing point area here, 3 candle formation here. Inside this area of inefficiency, you've also got it up here inside this area of inefficiency. And then you can see price action came down and pushed to the upside. So if you were to measure this new trading range right here, you will see that price action basically tapped 71%. So you could enter maybe there or off that. If you entered off that particular order block level here, off these order blocks right here, or inside this area of inefficiency, which you should be able to see here, for example, you would have been involved in this trade up to this level right here. And in fact, you could have targeted this particular trade. You could have literally got into here with a view of holding it. Let's say you entered at the top here with your stop loss here. You could have got involved for a 4-to-1 or something like that. And then you can try and follow this price action to the upside. You can see here, price action is creating this huge bullish range. If you measure this level right here, you can see price action come back into, I don't know why I've put that there. You can see that price action came back into our kill zone, which is also in line with this particular order block right here, which almost to the pip, as you can see, got hit. So you could have entered at this order block inside your particular kill zone for a second entry. So let's say you got involved in this particular trade here, for example. That's the wrong one. Let's say you got involved in this particular trade right here with your stop loss to there, and it wasn't a very good risk reward setup. So let's say you didn't take it. Well, that's absolutely fine because we still have a higher time frame bias. If you enter at this particular order block and you take this position here, you'll see that you got a 3-to-1 out of it. And let's say you missed this position here, and then you're wondering why price is suddenly dumping. It's because the higher time frame levels right at the top here have now been close to being taken. You can see here, taken. And then price action comes all the way down, rebalances, pushes to the upside again. So there are plenty of opportunities that happen within the markets. You just have to be aware of what's likely to happen. I would imagine this particular drop down here was in line with some sort of news event, if I'm being completely honest. But even then, price action comes back into this trading range, which is seen right here. And then price action looks as if it's respecting this area of inefficiency, as you can see. And inside this area of inefficiency, we've started pushing higher. You could look to frame entries all the way up to this level here. And then it's nothing, whatever happens up here is no longer relevant. We're now looking to identify prices dropping. As you can see from this level here, from a 1 hour time frame, you can see and identify we've got this trading range, which is right here. The reason I like this trading range is because this is one that swept this liquidity here. Price action comes all the way back into this level right here. This is our kill zone, which is actually right here. We've also got this order block, which sits like this. Now, the good thing about this is we don't, we can be as fractal as we want with this. We can try and go a little bit lower to try and frame some sort of entry. And inside that level right there, you can see price action looks like it came into 50%, which is also this area here. But you can enter at 50% if you want. You can enter at the OTE level if you want. It really doesn't matter because the target is this level right here, the higher time frame draw on liquidity. So if you entered at inside this imbalance right here, based off this retest, that's the sort of risk reward trade you're going to set yourself up with. There are situations where we lose in price. Of course, there are situations where we lose in price. We have to try and understand that. And actually, if we look at the higher time frames here now, and we just kind of try and remove everything, you can see that we've started dropping lower. And when we start to drop lower, we can look to try and frame these particular areas of imbalance, and we can look to try and identify clear objectives that the price is likely to gravitate towards. And inside there, you'll start to potentially understand why price action has started creating lower price action. If it carries on moving lower, you can look to identify that. And as you can see, price action is now starting to try and push higher, which might mean there's an area of inefficiency. In fact, there is right now. You can see it's reacting from this weekly area of inefficiency, meaning if we can start pushing higher, I would be looking for an optimal trade entry level or an imbalance or an order block or something like that with a potential now target of this particular high right here. So if you're a gold trader, you could be looking for buys all the way up to this level here, because on the weekly time frame, you are bullish. And if this area gets broken, then you look to go bearish. You could then potentially look to target this area here. It's just a notion of repeating itself over and over and over. And you can do this on any time frame. You can do this on any pair. It really doesn't matter what you look to use, as long as you are in line with the likelihood of what is going to happen. You can see right here, daily area of inefficient price action. This is real-time price action. From a 4-hour perspective, this area right here. So it has actually started to give us a reaction from this daily area in a 4-hour area, you can see right here. And now from a 1-hour perspective, you've actually had a huge shift in price action. Maybe price action comes back up to here and then drops again. And the target will always be the lower level of liquidity, which is exactly where we want to try and take price towards. So this is market structure as a brief introduction. We are going to go deeper in terms of really finding the high probable setups and things like that. Hopefully you found this insightful, and I will speak to you on the next one.